In the last video, we were looking at standalone risk. And in this video, we're going to say, well, yeah, but that's not the real world. And in fact, in the real world, investors can hold more than one investment. They can buy lots of different stocks, for instance. And therefore, how does holding more than one thing affect my behavior, or should it affect my behavior? Risk should still be important in pricing assets given their expected return. And in fact, let's talk a little bit about the returns to different stocks. This is data that it was presented. I found this actually on a researcher's website online. This is looking at the returns to large company stocks over a very long period of time. And this is the year-by-year return to the S&P 500. So you can see that in 1928, had you held the S&P 500 as your stock portfolio, you would have ended up with over 40% return on your investment. But then in 1929, there was the stock market crash, and we went into the depression, and so you can see we lost a whole bunch of money. Only in the mid-30s to start making a good chunk back. But you can see that it goes all over the place. Now, I tried to hold that y-axis constant as we went through the rest of these, because this is the stocks. These are returns over that time period to stocks, and by the way, it goes all the way up through 2013, so you can actually see how high they are and how volatile they are. This, on the other hand, is the 10-year Treasury bonds. They don't go quite all over the place. Now, the Treasury is the U.S. Treasury. That means government debt, which is seen as not as likely to go bankrupt or go away. And 10-year bonds have, as we found last chapter, a little more interest in them because people are tying up their money for 10 years, kind of. And so that should be different from, let's say a Treasury bill. Treasury bills are U.S. government debt, but they come due within a year. And this is the return you would have earned had you just turned over your money in Treasury bills over that same time period. Obviously, it looks like anyway I'd be making more money, although it'd be taking on more risk, if I got some stocks or even bonds. The bonds actually ended up with a few negatives, whereas the bills really haven't any negatives. So looking at these, I then decided to look at a histogram of the same information. Now, a histogram will say how many times, and so the x variable here, where it says 0, 10, 20, 30, 40, 50, 60, those are the percent. So 0 to 10%-ish, then 10% to 20%, and so on. So how often do we get in the 60 percentile range? Well, it happens. By the way, the average for these large company stocks over this time frame from 1928 through 2013, the average annual return is 11.5%. Positive 11.5%. Could be all over the place. I could have lost my shirt. Could have lost around 40%-ish. Notice that did happen, because there is something in there with this histogram, but there's not a lot. Most of it hovered around the 0 to 20-ish range. Standard deviation 20.02%. If we look at the long-term Treasury bonds, you can see us sticking a little closer to the middle. I know some of you are thinking, this is what I want to show you, Bauer. No, I'm just kidding. This looks like a wave with not all the fingers showing, okay? So this one is the long-term Treasury bonds. We have the mean of 5.21% over that same time period from 1928 through 2013. So if I'm going to be investing in large company stocks, probably going to be making twice as much as a return. But note the standard deviation went from 20.02% down to 7.85%. I'm a lot more certain as to what I'm going to get out. Even if I buy it this year and have to sell it in another year, I'm still a lot more certain that I'm going to make money. Only rarely do I lose money. And then if I'm looking at Treasury bills, it's even more certain. The average in this instance is 3.57%. The standard deviation now has actually gone below the mean. And what's interesting about that is that means that the Treasury bills coefficient of variation is actually less than 1. So for instance, going back to which one is riskier, remember this little graph, and I said, oh, obviously that the riskier one is the one in the black. That kind of tells you we need to go back and look at these, saying if I drew that normal curve around them, notice this one would go way high, this one wouldn't go as high, and this one would be squatty like crazy. That's really what we're looking at when we say these normal distributions. The ones that are high and skinny have less variation than those that are short and squatty like this one is. Now, if we take those same numbers, these are actual numbers based on what we just did, and we said let's plot the T-bill return. Now notice the returns are on the y-axis in percent, and the standard deviation is along the x-axis. So we're taking, in the case of the T-bill, we're taking the 3.06 on, or whatever it was, on the standard deviation and plotting the 3.57 on the return. So we're just taking both of those and plotting them together. And then we're just drawing a line between there. Does it look like there is a relationship between risk, my x variable, and return, my y variable? At least to me it looks like there is a relationship. And now I have to give you, you've suffered enough, I have to give you the comic. A very little humor. If you were in my face-to-face class, this is where I say, it may not be funny, but at least it's not me. Portfolio returns. Risk and return should not be evaluated in isolation. Each security should be evaluated in its risk-return trade-off to the portfolio, since I'm holding everything together in one big portfolio. The portfolio's expected return looks like this. And again, this all comes from normal statistics. So if you took a probability or a statistics course from the math department, you'd find out that the expected returns would work this way. Now in this instance, let me explain what everything is. The R hat sub P is the expected return. That's what R hat means in general. And the sub P means for the portfolio, is equal to the W's, W1 through Wn. That's how much of my total portfolio I hold in asset, whatever it is I'm looking at. In this case, I should say asset I. Okay. So in the first asset, whatever that one is, I have an expected return. That's R hat sub 1. I also have a certain proportion of my total portfolio that's held in asset 1. That's W1. And when I say proportion, I mean if I hold 25% of it, it's 0.25 is what W1 would be. and so on. By the way, that means that if you added up all the W's, just the W's, they would have to sum to 1. Those researchers who have used this as part of their inputs into their models did not usually constrain the W's to be positive. I mean, you could do that. You could say, well, and you can't have any negative proportions of your portfolio, because that doesn't make sense. Because guess what? Yeah, actually it does make sense. Because especially if you're talking about stocks, I can sell stock that I don't own, believe it or not. It's called a short sale. And if you want more information on that, I would ask you to take an investment class. So all my W's have to add up to 1. The R hats are just the expected returns for every asset in my portfolio. So in many ways, what I'm looking at when I look at the return to the portfolio is just a weighted average of the returns of every asset in my portfolio. So that just makes a heck of a lot of sense. That's what I should expect from my portfolio returns. Now remember that returns are only half of our equation. The other half is, of course, the risk. Portfolio risk is not just a weighted average. If we calculate standard deviation of the portfolio, it's a complicated mess. Take a deep breath. I'm going to show you this, and it's going to have a Greek letter in it that's going to throw you off. And it's not a P, even though it looks like one. Okay, so here we go. Oh my word, right? This, by the way, notice the symbol on the left side of the equal sign is not just a sigma. In other words, it's not a standard deviation. This is a variance. This is a variance. This is the portfolio variance. And you'll note that I'm not stuttering here with the 2 summation signs. We're actually summing. The best way of thinking through this, by the way, is back in the old days you'd have these, you'd open up your map. I remember opening up a map, and it would always have this mileage chart at the bottom to tell you how far it was from like Lubbock to Dallas, Texas. And you just look up the row that said Dallas, and you'd look up the column heading that said Lubbock, and you'd find the intersection, and that's how far it was from one to the other. This is sort of that same sort of thing, okay? So for each, just picture this big table of a bunch of numbers. And we're going to pretend like these numbers are made up of all of these WW row sigmas in there. If that's going to be kind of messy for a lot of people, but here's essentially what we're doing. We're looking as we go across. We'll just call our rows in this table my I's, and my columns are my J's. Okay? So my first cell, I have a number that's a W, which is telling me the proportion of asset number 1, for instance. If I'm starting at 1 and 1, this is like the asset 1, the amount in the asset in the column heading. Well, if I'm in 1, they're both the same 1, so I just get W squared. And then I have row, which is how highly correlated are assets I and J. If it's the same one, they're perfectly correlated, and that becomes a 1. And the sigma I and the sigma J, well, they'd be the same thing, and so it would be a sigma squared. Oh wait, that means that if we're in 1 and 1, I'm just going to get W squared times the variance. It's only when I'm off that, what's called the main diagonal of that table, that I get anything other than a variance, which is, by the way, most of the table. And because of that, it's hard to actually picture this unless you've done some matrix algebra and such. Because of that, it's interesting to note that there are quite a few off-diagonal entries, and that rho therefore becomes very important. That rho is the correlation coefficient. If I want to translate this whole mess into standard deviation, which is how we're really measuring portfolio risk, we'd just take the square root of that big messy thing and would get it. But the key to all of this is that formula itself, the WIWJ rho IJ sigma I sigma J. From that, if I think about it and what it's really trying to do, summing up all that stuff in this big long honking table, that's essentially all it's doing, I can come up with some interesting conclusions. So here's my little formula again, and all I did was reproduce it so that we can take a look at it and draw a few interesting conclusions here. Number one, realize that the risk is a function of the way I've weighted the assets in the portfolio. The more I put them on a very risky asset, because that's going to increase the W and it's going to increase the sigma, it's going to affect the sigma squared of the portfolio. However, it's also going to depend on the individual standard deviations. The higher that standard deviation is for each new asset I add to the portfolio, the higher the sigma squared of the portfolio is, the higher the risk of the portfolio is, unless the correlation coefficient between the new asset and the portfolio essentially is negative. If the correlation coefficient between the new asset and most of the old assets is negative, then a higher standard deviation would actually be a good thing. Correlation coefficients, that big rho thing, is a measure of the degree of relationship between two variables, the I variable and the J variable. It ranges from a -1 to +1, and therefore the higher negative it gets, the more you can reduce the overall risk to the portfolio. If the correlation coefficient is less than perfect, positive correlation, then overall portfolio risk decreases as you add more stocks to a portfolio, which is why risk tends to go down to a certain degree as the number of stocks in a portfolio go up. If you could find perfect negative correlation between two stocks in a portfolio, you could completely eliminate portfolio risk. Problem: risk can usually only be reduced so far, and the reason for that is almost all stocks are positively correlated. They may not be highly positively correlated. In some instances they may not be correlated very much at all, but it's usually positive. It's rare to find one that's negatively correlated. As the number of stocks increase, the risk will approach the standard deviation of the market portfolio. So, in other words, as the number of stocks, that's the X variable, as the number of stocks in the portfolio get bigger and bigger and bigger and bigger and bigger, you can see early on the overall standard deviation of the portfolio goes down rather precipitously, but then as we add more and more and more, it goes down slower and slower and slower. Essentially, there's a chunk of that overall portfolio risk that we could get rid of. If we could just get more and more things in the portfolio, we could get rid of it. Therefore, there's this level that if we could ever get out there to the market portfolio, would be systematic. It would be non-diversifiable. We can't get rid of it. And then the stuff up above that, the green in this particular graph, is unsystematic, it's diversifiable, it's company specific. I only have that because this company does things differently, or there are some risks associated with holding this company that I don't have holding another company. Now, the reason that I can get rid of it if I take on enough stocks is as one goes down because there was that company's specific risk, another value goes up. Because not all risk is downward risk. In other words, just because I didn't know what was going to happen doesn't mean it's bad. I could have been completely surprised by good news. That's risk in essence, because it was something other than what I had expected. So, as more stocks are added to the portfolio, each new stock has a smaller risk-reducing impact on the portfolio. The portfolio standard deviation falls very slowly after about 40 stocks are included, with the lower limit of the portfolio standard deviation being the market standard deviation. One thing that we have found through research, though, is that forming well-diversified portfolios, investors can eliminate about half of the risk of owning a single stock. Because of that, it makes some sense that the markets don't reward you for risk you don't need to take. All of this brings us to a more formal statement of the relationship between risk and return.